Welcome back, as today we're focusing on insider buying. As always, specifically looking at companies where we get to see directors, presidents, CEO adding shares of companies that they work in. Reason for this is a fairly bullish signal. As Peter Lynch always says, management buy because they believe the share price will go up. So let's take a look. We're going to look at a selection today, kicking off with the one that's just been added yesterday, Eli Lilly and Company. No surprises, given it did suffer quite a drastic drop, and we can see the director added. Perhaps something will see them, CEOs, presidents, and more directors add, as this company just in the last 5 days is down around 18%, pretty much what we see year to date as well. Yet if we zoom out to the last 10 years, this is one that has been quietly outperforming the S&P, up 646%. It is also trading at a 52-week low, where we see both Wall Street and Seeking Alpha consider this a buy. Wall Street 4.2, very near the 4.5 to flip this into a strong buy rating. And we'll just mention why the company took such an enormous hit. Yes, they did have a double beat on both earnings per share as well as revenue, where we see not just year over year, but also quarter on quarter, their numbers are up double digit. In fact, earnings per share up 89% from the previous quarter, revenue up 22%. This is clearly, as we will show you, a high growth company. But the reason why their share price did in fact shatter was because their weight loss pill showed that those customers who were taking it lost around 12% of their body weight. That is after more than a year, something that analysts were expecting to see slightly higher, and in fact came lower than what was shown via Novo Nordisk, which actually saw those share prices, which had been suppressed, increase just last week. The other thing that actually went under the radar, given that the weight loss pill actually came in lower than expected, was that they raised their full year earnings, always a great sign to see. And perhaps you could argue, like we just saw from the director, now might not be a bad time to consider buying. Forward valuation 23.5, well below the 5-year of 38. As always, that is a severely undervalued signal, but we don't look at this purely in isolation. Also, we should make you aware the yield today of 1% is slightly below historical 1.2, and you'll be happy to see the dividend safety score does look very safe, a 96 figure, and we can see just in their most recent increase, as they do typically year after year, increase the dividend double digit 15.4%, and consistency with the previous model we get here based on the blue tunnel methodology, another severely undervalued signal. Remember, blue tunnel within the parameters, the fair price, we're seeing the stock price decrease in the last year, the intrinsic value of the price go up in the opposite direction and continue the upward trend. Always a great sign when you want to look for undervalued opportunities. Perhaps the market did overreact. We may see a very, very large rebound into next week, or perhaps we won't. Just something to bear in mind. And we'll also highlight here that over the last 5 years, this company for the longest period was trading at a severely overvalued level. You could have only got it in severe undervaluation in just the last few months. Doesn't necessarily mean it is a buy right now, but all of these things can make up your overall investment thesis. And as you can see, valuation does come at an F, but we'll highlight the growth, which is an A+, profitability as well, as you can see if interested, also scoring extremely highly. As you can see, the sector does come in a lot lower at 17.3, meaning you are paying a 61% premium, but I'm sure as you're aware with the company, it is one of those that does justify trading at a premium. Question is, as we'll show you in our own valuation, how much of a premium should we be paying? And you can see in terms of the last 5 years, this is one that now trades at a discount, something as we mentioned earlier has only started to show recently. And you can see no matter what metric you look at, Eli Lilly trades at a very large premium to the sector, but actually consistently at a discount to their own 5-year. They're also expecting double digit at a bare minimum of growth for the next 4 quarters. In fact, Q3 upcoming, remember they've raised guidance. They believe they will hit 435% growth year on year to the EPS. Q1, in fact, of 2026, near a triple digit, and we would have to just make you aware that over the last 4 quarters, they've outperformed on 2 of them, 50% track record, most recent one, fairly substantial beat. Now looking forwards towards December 2026, their next full accounting period, if they hit their EPS target, they're trading at a forward valuation of below 21. Looks good if you believe in the company over the longer term. And they're also producing some very strong numbers, 37% revenue growth year on year, expected this year at 28. Not only is that above the sector, which, let's be honest, you would expect given the premium it's trading for, but they're anticipating to grow faster than they have done over the last 5 years. And in fact, last year they did grow faster. So actually interesting to see it's trading at a discount to what they have done in the last 5 years. And EPS expected 32% growth over the next 3 to 5 years, much higher than the sector at 10, also much more than the historicals, telling us here now, Eli Lilly, you're getting a huge discount to their 5-year average, yet they're growing both revenue and projected EPS at a much faster rate. We will make you aware though that institutions with their 83% ownership, yes, they sold 83 billion and bought a lot more in the same time frame at 128 billion. We're talking on a trailing 12-month basis. However, in the most recent quarter, we can now see institutions sold a large portion more than they did buy, 42 billion versus 4 million buys. Previous quarter though, we pretty much saw the opposite effect where they were net buyers, and actually if you want to see another quarter where they sold a lot more, you'd have to go Q2 2023. We also want to flag what super investors themselves are doing, especially as we're getting more 13F filings for this latest quarter. Now 8 of them hold this in their portfolio, but interesting to see here, we have one super investor that has made this a new position, adding 207,000 shares. Not a lot, at around 2% of their overall portfolio composition, but remember, these super investors, they do manage, we're talking billions and billions of dollars, so it is still fairly significant. And the other thing you have to consider with any big pharma company is this talks of tariffs. We see again just days ago Donald Trump saying that they could eventually reach 250%, and whilst for the time being they will just start off with a small tariff, he believes in 1 year to a year and a half, he says here maximum, that it will be raised to 100 and then 250%. Lots to consider, but this does also affect the industry as a whole. In our own valuation of Eli Lilly coming to $691 derived from the DCF model is using a growth rate of 35%. Bear in mind, based on a reverse DCF model, 33.5% is baked into the share price as of today. If you believe it should be higher, then undervaluation could arise, and vice versa if you believe this is way too much overvaluation. Now our growth rate of 35% is lower than the average of 44 in the last 10 years, and you can see here we have low, medium, and high. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Eli Lilly or any others, but with the growth rate and the discount rate, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, arrive at the equity value, which we divide by the shares outstanding, getting to 691, indicating 11% upside. If you believe that is way too much, well, at 30%, $491, and if we go to the most optimistic here today at 40, 958, indicating 53%. As always, we do like to take through the middle rate, not finished, because we want to see what is the margin of safety on offer, where we kick off to begin at 10%, execute on that if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data. If you believe that today, pretty much saying it's a buy with a 10% MOS around the current value up to 622, 623. So that is what Eli Lilly is showing. Wall Street themselves still very bullish. We have big analysts still reiterating this is a buy. We're talking JP Morgan and others with an average target of $980, translating to 57% upside. So let us know your view on number 1, where we just got a director buying the dip. 10% MOS, 57% upside. Do you see it as a buy, hold, or avoid? We'll highlight here at 20%, a buy at 553, and at 25, 519. So just 10% for the time being, but we'll also use 40%, which is clearly the estimation that Wall Street believe to be most appropriate, given the intrinsic value of 958 isn't too dissimilar from where they see this next year. And what that ultimately means is that the margin of safety level is going to be a lot higher, and we can see you're getting around 35% as opposed to the 10% prior. Eli Lilly, number one, give us your thoughts. Before we move to the next stock, just to let you know, we have released our latest free weekly article. We do one every single Monday morning covering undervalued stocks as well as what's good in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of August, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. The next stock we're moving on to is MSCI, where the chairman and CEO just a few weeks ago added 12,400 shares. This cost them just under $7 million. And this is one that's only up 3% in the last year. Year to date, in fact, is down around 9%, but similar to Eli Lilly, over the last 10 years, they have massively outperformed the S&P. Now we notice it's trading around the mid to lower end of the 52-week range. Very similar ratings from Seeking Alpha and Wall Street, who do believe, alongside Eli Lilly, MSCI should be some serious consideration in the portfolio. And we can see another severely undervalued signal, forward P30 versus 39 historically. But unlike Eli Lilly, you're actually getting a higher yield today, 1.3, than the 5-year average at 1, and a safe score on the dividend at 61. Just this year, in fact, the dividend was increased by 12.5%. Now, if we take a look at the blue tunnel, we can see not only severely undervalued, not only is the blue tunnel increasing over time, but this one for quite a period has been trading in an undervalued level. Perhaps this is an unloved stock by the market, one that there are many names in a similar bucket. But actually, over the last 5 years, when we zoom out, it's gone for a period from 2020 to 2022 in severe overvaluation, from 2022 to around 2024 in the reasonable signal, and from mid-24 to now, we have seen this consistently in an undervalued level. Maybe saying that soon we should see this go back into the blue tunnel, but this is a very nice graph. The intrinsic price has only been increasing year on year, moving in the right direction. But we also get a poor valuation grade, sector sitting a lot lower at 11. You are paying a 200% premium, but we do notice a discount to their own 5-year. Pretty consistent again, no matter which valuation metrics you look at. MSCI, massive premium to the market, but a discount to their historicals. And we always love to see green right across the board, 100% in terms of a record against analyst targets. We see growth anticipated moving forwards, and based on December 26, a forward P of 28.5. Now the growth at a C does show they are very consistent, growing around 10 to 11%, which is slightly above the sector median in the mid to high single digit, but slightly below their own 5-year. We're just talking a few percentage points, with EPS projected to grow 11%, not too dissimilar from the sector, but a little bit below their own 5-year of 14. Now this is a very consistent company as we stretch back to 2019. Both revenue and their EBITDA continues to move upwards, double digit 11 to 12%, and it's also one that has heavy institutional ownership at 90%. We're talking 6 billion selling, 8 billion buying. However, in the most recent quarter, we did get a little bit more selling than buying. If you want to see another quarter, then you'd have to go Q1 2024. But more often than not, as you can see, institutions do consistently love MSCI. And super investors, 6 of them owning this company, we can see in the latest quarter, very marginally, we do get here 2 of them who have been adding more to their overall position. In our intrinsic value, $709, as you can see, another DCF calculation. Firstly, baked into the numbers, 10.6%. We've won 14 moving forwards, lower than the average of 21, which is, as we can see, the increase in 2024. 12% in the year prior. Now, based on this number, you are getting 30% upside. Nonetheless, 12 and 16, we can see numbers that are showing this company looking to be undervalued, but using a margin of safety on that middle rate, you can see as of today, not 25% just yet, sitting somewhere between 20 25. Wall Street themselves, $650, 19% upside. Now, if you want to be more conservative and use a rate of 12%, you can in fact see you are still getting a margin of safety. 10% is pretty much where we sit today, and when we've done our deeper dives, this company truly does encapsulate when we talk about high quality companies. MSCI though, let us know, massive insider buying, in your view, a buy, hold or avoid. We then move to UPS, where we actually get a double buy, direct in fact, 31st of July, adding 5,000 shares, 433,000, but we get an even larger one by the CEO on the 1st of August, adding just under 12,000 shares, costing them around $1 million, and this one pummeled down 31% over the last year. Year to date, a very similar scenario. Over the last 10 years, not good at all, in fact, down 16%, you would have less than your original investment, trading pretty much at a 52-week low, where we get a double buy again from both Seeking Alpha and Wall Street. Now, this one reported their earnings a few weeks ago, where they did miss on the earnings per share, a marginal revenue beat, but what didn't look that good, both EPS and revenue down from the same quarter last year, where we can see they also had a lack of guidance, never good to note, and for UPS, given their business model and what they do, they also delivered fewer packages. Definitely not something investors or even prospective investors wanted to see. And we also got some more bad news. In fact, this is a bearish signal. Ending the de minimis rule will slow down cross-border e-commerce, reducing package volumes, not just for UPS, but also FedEx for those that are interested, meaning fewer shipments, higher cost for customers, and ultimately investors see this as a hit to growth in their key business segment. And this company, forward valuation of 13, is well below their 5-year of 16. We actually get a very attractive yield in isolation, 7.6%, well above the 5-year average of 3.5, which on the face of it does look like a double severe undervaluation signal, but we have to make you aware dividend safety 50 borderline safe is never a good sign, and the fact that they continue to really increase the dividend at a very trivial rate, 0.6% this year, again, not something if you want perhaps more of a dividend growth mindset. And the reason why we do get to see that borderline safe score when we uncover the free cash flow payout on a trailing 12-month, 157%, 90% expected over the next 12, and we've seen a few years where it has been in the triple-digit rate, signaling that this company on a trailing 12-month basis and for a few years has paid out more in dividends than they generated in free cash flow. Something as always to take note of, but we do also see that severely undervalued signal here, something we don't like. As you would expect, the expected intrinsic value has been decreasing in the period. And actually, when we zoom out to the last 5 years, that has been a trend from 2022 where it has been declining. Definitely something we would say to take note of. And they do get an A on the valuation. No surprises given how far they have fallen. Sector a lot higher at 35%. But just how we ask ourselves the question for companies that trade at a premium, we also need to think about, are some companies actually deserving to trade at a discount? And that, again, we will get onto. In terms of the last 5 years, as we've highlighted, also trading at a discount, no matter pretty much for the vast majority of valuation metrics you look at, UPS, a discount to both 5-year and the sector. Not much better news either when we look at their earnings projected over the next 4 quarters, only one expected growth, although they do have a 75% track record. Most recent one, as we highlighted, was a miss. Projected 2026 EPS 11.8. Now growth, as you would expect, also not looking good, D-. We're talking 1% last year, decrease of 1% expected this year. That is well below the sector in the mid-single digit rate, and that is also where they have historically hit in terms of their top line. EPS not looking the greatest either at 6%, below again both sector at double digit and their own 5-year at 9. Now institutions with their 60% ownership selling $8 billion actually bought 50% more in the last year. They've bought more than twice as much in the most recent quarter, so actually very interesting to see. Perhaps they have also turned bullish. If you want to see the reversal, well, Q2 2024 also noted in Q1. And then finally, when we look at super investors, 3 of them holding this position, we do get in the most recent very minimal but some trimming from in fact 2 of the 3. In our intrinsic value, $108, the average of the 4. As always, you can grab a copy if you want to play with the numbers, UPS or any others. We'll actually give you a margin of safety given where the company sits today. As we keep on going, we're talking 20%. Wall Street themselves also see upside 23% into the next year, $107. Question is, has this company now finally bottomed? We saw quite a large insider buying. We're seeing nice MOS, nice projected upside, but let us know your thoughts. And for those that want to see it 25%, a buy at 81. UPS, buy, hold or avoid. We'll then highlight 2 other companies, first one here being EPD, where we get the director buying 16,000 shares, costing him $500,000. Now this one's actually up over the last year 7%, year to date pretty much flat, and over the last 10 years not the greatest, we're talking up 11, currently trading in the midpoint of the 52-week range. Actually 2 fairly respectable buy ratings from Seeking Alpha and Wall Street, Seeking Alpha very close to a strong buy, and we get their forward P to DCF ratio not too dissimilar from the 5-year average. You could argue a very similar story for the yield, so both accounts at a high level showing reasonable signal. And the dividend does look to be safe at 65, great to see for a yield around the 7% mark. They also increased the dividend over the last year in line with inflation at 4.1%, which actually is pretty good, especially given the high yield. And very similar to what we just mentioned, even the blue tunnel here pretty consistently around a reasonable valuation. Although when we zoom out to the last 5 years, we can see the intrinsic price hasn't really moved too much, although we do notice the share price over the period moving up in the right way. And institutions, not massive ownership at 26%, selling 1.6 billion, bought a little bit more at 2.1. They actually sold a little bit more in Q2, but we also notice another larger sell than buy in Q4. So overall, we would say for the large part, they're neither bullish nor bearish. And our intrinsic value comes around $35. We'll give an MOS of 10%, pretty much around the $31 mark. Wall Street themselves, $36 into next year, 14% upside. So very similar to UPS, we have companies that are offering very attractive yields. So let us know, maybe you like one or maybe you like neither. And then we'll also reflect on ELV, which is here where the president and CEO added. We're talking around 2.5 million shares worth. And this one down 44% in the last year, year to date down 20%. Over the last 10 years though, it is up 97%, not the greatest, and trading near their 52-week low, with another double respectable buy from both Seeking Alpha and Wall Street, both in fact close to a strong buy, one that has, like the majority of the industry, really taken a large hit. And we get a double severe undervaluation signal, 9 versus 14, yield 2.3 versus 1.2. But great to see the dividend safety, highest score obtainable at 99, very safe. A roughly inline inflationary increase as well at 5% this January, with also a severely undervalued signal, massive disparity, but we should make you aware again that the intrinsic value has slightly decreased. But that is something we've just noted in 2025. Prior to that, the last 4 years, it was trading in a reasonable signal and the intrinsic price was moving in the right way, although just in 2025, both intrinsic value and share price have taken a large hit. Now institutions, 90% ownership, selling 10 billion, bought 50% more at just under 16. They also bought around 50% more in Q2. They've been fairly bullish, in fact, over quite a long period of time. If you wanted the reversal, you'd have to go all the way to Q1 2023. So definitely one, not only net buyers in the last year, but been bullish long term. Now our intrinsic value, $417, again, average of the 4, will give a nice margin of safety, something we have been saying for quite some time for ELV. At 30% is where we see this today. Wall Street 370 into next year, 26% upside. Give us your thoughts, buy, hold or avoid, and generally with these stocks, one, do you like us covering insider buying? Would you like us to take a look, in fact, at insider selling? Are these stocks maybe ones you want a deeper dive? As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.